Here's the recipe for impressing investors when you're not already good at seeming formidable. Number 1, make something worth investing in. Number 2, understand why it's worth investing in. Number 3, explain that clearly to investors. If you're saying something you know is true, you will seem confident when you're saying it. Conversely, never let pitching draw you into bullshitting. As long as you stay on the territory of truth, you're strong. Make the truth good, then just tell it.
This episode of the Disruptor Journals is brought to you by Lunio Digital.
A very dear friend of mine, building a business in the logistics sector, recently expressed interest in raising capital. His business has entered the growth stage. As I was trying to help him, it took me back to when I was raising money for Lunio Commerce, one of my ventures last year. And it made me realize a lot of things through the grueling process of pitching investors week in, week out, doing my own research, trying to see what the great founders did to raise money. I realized a couple of things. The first one being, inexperienced founders tend to make the mistake of trying to convince with their pitch. But I realized that you're better off letting your startup do the work. That is, you have to figure out and understand why your startup is worth investing in. Then, simply explain this well to investors. Investors look for startups that will be very successful. But like with many domains in the world, the distribution of outcomes follows a power law. In startups, the curve is very, very steep. Big successes dwarf the rest when you think of your Stripes, your Googles, and the likes. But the conventional wisdom says there are usually only 15 big successes each year. So how do you seem like you'll be one of the big successes? I figured out, and with help from studying great mentors and entrepreneurs like Paul Graham, you need 3 things. Number 1, formidable founders. Number 2, a promising market. And number 3, some evidence of your success so far. But the most important thing I've realized with this is formidable founders. Now, when you're formidable, it is when you seem like a winner. When you seem like a winner, they'll like you. A formidable person is one who seems like they'll get what they want regardless of whatever obstacles are in the way. Inexperienced founders, though, should stick to the truth. And by this I mean, they should look formidable by always telling the truth. If I ask you the answer to 1 + 1, you'd confidently answer me 2, because you know it is true. You can also say the same for a startup founder saying a bold statement like, "We are going to make $1 billion." A founder can claim that they're going to make $1 billion and seem formidable as long as they've convinced themselves first. That's the secret to this whole thing. Convince yourself first that your startup is worth investing in, and when you explain that to investors, they will believe you. To evaluate whether your startup is worth investing in, you have to be a domain expert. And investors can tell whether you are a domain expert by how well you answer the questions that they ask you. The point I'm trying to make with all this is, be truthful. Truth is your best friend. And you should also remember that the time to raise money is not when you need it or when you reach some artificial deadline like demo day. It's when you can convince investors and not before. And unless you're a very good con artist, you will never convince investors if you're not convinced yourself. They are far better at detecting bullshit than you are at producing it, even if you're producing it unknowingly. If you try to convince investors before you've convinced yourself, you'll be wasting both your time. But pausing first to convince yourself will do more than save you from wasting your time. It will force you to organize your thoughts, to convince yourself that your startup is worth investing in. You will have to figure out why it's worth investing in. And if you can do that, you will end up with more than added confidence. You also have a provisional roadmap of how to succeed. Now that you understand what a formidable founder or formidable team means and what it's capable of, I'm going to move on to the other factors that help you convince investors to invest. The reason why I started with and why I'm convinced, and Paul Graham convinced me that being formidable is the most important. You notice as we go forward to the shorter tips, being formidable is part and parcel of the whole package. So moving on to the market, you notice how I have focused on whether your startup is worth investing in rather than whether it's going to succeed. No one, absolutely no one knows if a startup is going to be successful or not. Investors know that every investment is a bet and against pretty long odds. Aside from formidable founders, to succeed, a startup needs a plausible path to owning a big piece of a big market. So as founders, we think of startups as ideas. But from the investor's perspective, they see startups as markets, and that's how they evaluate. This is to say that if there are X number of customers that would pay an average of Y dollars per year for what you're making, then the total addressable market of your company is XY dollars. Investors don't expect you to collect all that money, but it's an upper bound on how big you can get. Your target market has to be big, and it also has to be capturable by you. But the market doesn't have to be big yet. Nor do you necessarily have to be in it yet. It's often better to start in a small market that will either turn into a big one or from which you can move into a big one. There just has to be some plausible sequence of hops that leads to dominating a big market a few years down the line. So startups that usually get really big, they get lucky at some point, in the sense that their growth is due mostly to some external wave they are riding. So to make a convincing case for becoming huge, you have to identify some specific trend you benefit from. Usually you can find this by asking, why now? If this is such a great idea, why hasn't someone else already done it? Ideally, the answer is that it only recently became a good idea because something changed and no one else has noticed it yet. So let's take Microsoft as an example. Microsoft was not going to grow huge by selling basic interpreters. But by starting there, they were perfectly poised to expand up the stack of microcomputer software as microcomputers grew powerful enough to support one. And microcomputers turned out to be a really huge wave, bigger than even the most optimistic observers would have predicted in 1975. But while Microsoft did really well, and there's thus a temptation to think they would have simmed a great bit a few months in, they probably didn't. Good, but not great. No company, however successful, ever looks more than a pretty good bit a few months in. Microcomputers turned out to be a big idea and a big deal. And Microsoft both executed well and got lucky. But it was by no means obvious that this was how things would play out. Plenty of companies sim as good a bit a few months in. I don't know about startups in general, but at least half the startups that are funded could make as good a case as Microsoft could have for being on path to dominating a large market. And who can reasonably expect more of a startup than that? If you can make as good a case as Microsoft could have, will you convince investors? Not always. Most likely not. A lot of VCs would have rejected Microsoft. Certainly some rejected Google, and getting rejected will put you in a slightly awkward position. You see when you're raising money, like I did when I was doing my fundraising, that the most common question you get from investors will be, who else is investing? And this is true for any form of capital raise, whether you are a startup or you're a hedge fund even. What do you say if you've been fundraising for a while and no one is committed, no one is committing to your startup? The people who are really good at acting formidable often solve this problem by giving investors the impression that while no investors have committed yet, several are about to. This is arguably a permissible tactic. It's slightly dickish of investors to care more about who has committed to investing in your startup than any other aspect of your startup. And misleading them about how far along you are with other investors seems the only way to counter the way VCs behave when it comes to looking at who's investing in your business. It's arguably an instance of scamming a scammer. But this is the single most common lie told to investors, and you have to be a really, really good liar or a con artist as that to tell members of some profession the most common lie they are told. If you're not a master of negotiation, the best solution is to tackle the problem head on and to explain why investors have turned you down and why they are mistaken. If you know you're on the right track, then you also know why investors were wrong to reject you. Experienced investors are well aware that the best ideas are also the scariest. They all know about VCs who rejected Google. If instead of seeming evasive and ashamed about having been turned down, you talk candidly about what scared investors about you, you will seem more confident, which they like. And you probably also do a better job of presenting that aspect of your startup. The problem with being evasive or seeming evasive rather and ashamed about having been turned down, you're implicitly agreeing with the verdict of the investors who turned you down. So once you become honest about the scary aspects of your business and why investors are or have been turning you down, that worry will now be out in the open instead of being that dirty little secret left to be discovered by the investors you're currently talking to, who will be proud of and thus attached to their discovery. This strategy will work best with the best investors who are both hard to bluff and who already believe most of their industry peers are conventional-minded drones doomed always to miss the big outliers. Raising money is not like applying to university, where you can assume that if you get into University of Cape Town, you can also get into University of Limpopo. Because the best investors are much smarter than the rest, and the best startup ideas look initially like bad ideas. It's not uncommon for a startup to be rejected by all the VCs except the best ones. That's what happened to Dropbox. Not understanding that investors view investments as bets prevents founders from even considering the possibility of being certain of what they're saying. They think they're trying to convince investors of something very uncertain, which is that their startup will be huge. And they think that convincing anyone of something like that must obviously entail some wild feat of salesmanship. But in fact, when you raise money, you're trying to convince investors of something so much less speculative, which is whether your company has all the elements of a good bet, and that you can approach the problem in a qualitatively different way. You can convince yourself, then convince them, the investors. And when you convince them, use the same matter-of-fact language you use to convince yourself. You wouldn't use vague, grandiose marketing speak among yourselves. Don't use it with investors either. It not only doesn't work on them, but seems a mark of incompetence. Just be concise. Many investors explicitly use that as a test, reasoning correctly, by the way, that if you can't explain your plans concisely, you don't really understand them. But even investors who don't have a rule about this will be bored and frustrated by unclear explanations. So, here's the recipe for impressing investors when you're not already good at seeming formidable. And this is me rounding up everything and concluding this entire episode. Number 1, make something worth investing in. Number 2, understand why it's worth investing in. Number 3, explain that clearly to investors. If you're saying something you know is true, you seem confident. Conversely, never let pitching draw you into bullshitting. As long as you stay on the territory of truth, you're strong. Make the truth good, then just tell it. As simple as that.
Get a new website in 14 days with Lunio Digital's RapidX package. At Lunio Digital, we know that a strong online presence is essential for attracting and converting customers in virtually every industry. But we also understand that not every business needs an elaborate website to reach their goals, which is why we offer simple, results-driven designs to get you up and running and getting leads in just 2 weeks. Click the Lunio Digital link in the episode description to get started.
Thank you so much for joining me for this episode of the Disruptor Journals. If you're a startup founder, you'll be excited to know that in the next episode, I'm going to be talking about the lessons and the tools you can use to survive the funding winter. If you're running a startup, you know what the funding winter is. It's crazy out here. Again, I encourage you to subscribe, rate the podcasts, leave a review, connect with me on social media at the Disruptor Journals on Instagram, and subscribe to the newsletter. The link will be in the description. Thank you so much again for joining me. This is Cliff Nemachena signing out.